Welcome to How Startup Valuation Works from Idea to Exit. In this video, we'll try to overview and understand the complex world of startup valuation, why it's crucial for founders and investors, and the shifts defining the 2025 funding landscape. This content is for aspiring and current startup founders, investors, and anyone curious about the mechanics behind tech unicorns. Understanding valuation is key to smart fundraising, avoiding dilution, and building a sustainable business. By the end, you'll grasp the core concepts, common methods, and vital trends to navigate the startup ecosystem confidently. Please note, this video provides educational content and should not be considered financial advice. Always consult with a qualified professional for your specific financial needs. Startup valuation is often shrouded in mystery, especially when you hear about companies with no revenue being valued in the millions, or even billions. But at its core, valuation is simply determining the economic worth of a company. It's the art and science of putting a price tag on a startup, considering its current assets, future potential, and market conditions. So what exactly is valuation in the startup context? It's the process of assessing a company's worth, often before it even generates significant revenue. It's not just about what a company has, but what it could become. We'll also differentiate between pre-money and post-money valuation, two critical terms often confused by new founders. You might wonder, why are unprofitable startups valued so highly? It's because investors aren't just buying current profits. They're buying into future growth potential, market disruption, and the promise of significant returns down the line. It's about projected market share, intellectual property, team strength, and the size of the problem they're solving, not just today's balance sheet. Let's clarify pre-money versus post-money valuation. Pre-money valuation is the company's value before times any new investment. Post-money valuation is the company's value after times the new investment. This distinction is crucial because it directly impacts how much equity new investors receive and how much founders' equity is diluted. Why are some startups with no revenue still valued in crores? This often stems from their potential to capture a massive market, groundbreaking technology, or a highly experienced team with a proven track record. It's speculative, yes, but based on a deep dive into the opportunity and the team's ability to execute. Understanding these nuances is paramount for both founders and investors. For founders, it ensures you don't give away too much equity too early. For investors, it's about making sound decisions that yield substantial returns. A fair valuation creates a win-win scenario for all parties involved. Now let's explore why time valuation truly matters for startups. It's not just a number on a pitch deck. It has long-term implications for your company's trajectory, fundraising capabilities, and even your personal stake as a founder. Firstly, equity dilution. A higher valuation means you give away less equity for the same amount of capital. Conversely, a lower valuation means more dilution. This directly impacts your ownership percentage and control over your company. Secondly, future fundraising. Your current valuation sets a precedent. A highly inflated early valuation can make it difficult to raise subsequent rounds if your performance doesn't match expectations, leading to a down round, a significant blow to morale and reputation. Thirdly, reputation. A reasonable valuation signals maturity and a realistic outlook, building trust with potential investors. An overly ambitious valuation can make you seem out of touch. Finally, setting expectations. It establishes clear expectations with your team and early investors about the company's worth and growth trajectory. So how do investors actually arrive at these valuation numbers? There are several popular methods, each with its own strengths and weaknesses, and often a combination is used to get a comprehensive view. First, comparable transactions. This method looks at recent acquisitions or funding rounds of similar companies to determine a benchmark. It's often used when there's enough market data. Second, discounted cash flow, DCF. This is a more traditional method where future cash flows are projected and then discounted back to their present value. It's complex and highly dependent on accurate future projections, making it less common for early-stage startups with unpredictable revenues. Third, the venture capital VC method. This method works backward from a target investor return, example 10x in 5 years, and the projected exit valuation to determine the current pre-money valuation. It's common in early-stage VC funding. Fourth, the scorecard method. This method compares the startup to a, quote, typical seed-stage company in the region and adjusts its valuation based on factors like the strength of the team, market size, product, and competition. Finally, the The Berkus method. This method assigns a monetary value to key success factors rather than relying on financial projections, which are often non-existent for very early-stage startups. It assigns up to $500,000 for each of 5 elements: basic value, the idea itself; technology or intellectual property; management, the quality of the team; strategic relationships, partnerships; and product execution, getting the product to market. The valuation landscape is always evolving, and 2025 is no exception. We're seeing significant shifts compared to the exuberance of a few years ago. Understanding these trends is vital for any founder looking to raise capital effectively. Gone are the days of sky-high, often unrealistic multiples based solely on user growth. In 2025, investors are demanding more realistic multiples, placing a much stronger emphasis on core business fundamentals: profitability, capital efficiency, how well you use your cash, and strong customer retention. This means a solid business model trumps vanity metrics. The funding winter has led to more down rounds or flat rounds, where valuations are lower or stagnant compared to previous rounds. This is a tough reality, but it's fostering resilience. However, certain sectors like AI, SaaS, and climate tech are still commanding premiums due to their transformative potential and market demand. But even here, fundamentals are now paramount. Let's illustrate this with an example. Imagine a startup with 2 crore in annual recurring revenue. In 2021, it wasn't uncommon for such a company to be valued at a 20x multiple, meaning a valuation of 40 crores. The market was hot, and growth was king. Now it's not same. Fast forward to 2025, and that same 2 crore ARR company might be valued at a more conservative 6 to 8x multiple. This translates to a valuation of 12 to 16 crores. This stark difference highlights the shift from growth at all costs to sustainable, profitable growth. Understanding this change is crucial for setting realistic expectations. While we've covered the basics, there are several common misunderstandings about valuation that can trip up even experienced founders. Let's clarify these to prevent future headaches. First, higher funding does not always equal a better business. A massive valuation based on inflated metrics can set you up for failure, leading to unrealistic expectations and immense pressure. An overly high valuation can backfire, making it impossible to meet future growth targets and impacting subsequent funding rounds or even an exit. Second, valuation does not equal cash in hand. It's a theoretical market value, not liquid assets. Many founders confuse a high valuation with immediate financial freedom, leading to poor operational decisions. Always remember to focus on fundamental business building, generating revenue, managing expenses, and achieving sustainable growth. So what's our closing advice for founders navigating the 2025 startup landscape? It boils down to a few critical principles that will serve you well regardless of market conditions. Prioritize building strong fundamentals. This means focusing intensely on achieving product-market fit, demonstrating consistent and sustainable traction, and achieving high customer retention. These are the core metrics that truly indicate a healthy, scalable business, and they are what investors are keenly scrutinizing in the current climate. Be transparent with your data and your story. Don't hide challenges. Explain them with a plan to overcome. And finally, really understand and focus on 2025's key metrics: profitability, capital efficiency, and customer lifetime value. These are the true measures of a resilient and attractive startup. We hope this deep dive into startup valuation has been insightful. If you have a specific topic you'd like us to cover in a future video, please leave a comment below. We're always eager to create content that serves your needs.